Okay, in this video we will try to wrap up reading 51, and we're going to start with looking at corporate debt. Uh, Corporate securities are an alternative source of loans compared with bank loans. So real quickly, let's just take a brief look at bank loans. They are a very common source of debt financing in many parts of the world, and especially for smaller firms even here in the U.S. There are a few different kinds of bank loans. One, probably the most common type, is the bilateral loan, where you just have one borrower and one lender. A syndicated loan is going to be a very large loan with one borrower, and what banks will do is cobble together several lenders so they can kind of parcel out the risk instead of having one huge loan where a bank is very much exposed to a risk of default. We'll kind of have different pieces and parts that different banks will take and put those all together to make the loan to the borrower. These bank loans, are typically going to be floating rate loans. That means they're going to be tied to LIBOR or perhaps the prime rate, and then there's always going to be a spread that's added on to that reference rate. Another source of debt for companies, an important source of money, is commercial paper. This is going to be short-term in nature, and it's also unsecured. That means there's no collateral attached to it. And the short-term nature, the typical commercial paper is going to mature anywhere from 30 to 90 days. Without going through a registration process with the SEC, it has to be less than 270 days, and in no event can it be more than a year. So it's typically going to be very short-term. Borrowing, it's always priced on a discount basis. So as an example, if you wanted to borrow $100 million and the going rate was 2%, and you're going to do this with 6-month paper, your interest charge, if you do the math, would be $1 million. And so what happens is you would only receive $99 million, but you're promising to pay back $100 million at maturity. So you don't get the full proceeds at issuance. You back off the interest and you receive that net of the interest that you're going to ultimately pay. And then when it comes time to pay it all back at maturity, you pay the face amount of the loan. Commercial paper is an important source of bridge financing. So that is to say that you can use commercial paper as you're waiting for a longer-term bank loan or to issue a longer-term debt security, a bond. Commercial paper is frequently rolled over. That is to say, if you got 30-day commercial paper, at the end of that 30 days, you're typically, as a company, issuing new commercial paper to refinance that existing commercial paper. So you're kind of perpetually rolling this over. And that can create a delicate situation where you have rollover risk. If something drastic happens in the commercial paper market and you're unable to refinance or roll over that existing paper, you could be left in quite a bind. You'd either have to use a line of credit, a backup line of credit, to help cover that situation, or dig into other corporate funds. In the worst case, you would default, and that's going to be a whole big problem, a whole different ball of wax. So rollover risk can be substantial, especially in times of financial uncertainty, kind of a financial crisis type of a thing. And then lastly, with commercial paper, it's always rated. There's prime commercial paper, and that's going to be commercial paper that is rated either as superior, satisfactory, or adequate. You have other ratings, speculative and defaulted commercial paper, that aren't going to be investment grade, basically. So commercial paper has a slightly different rating system than regular bonds, but they're kind of rated on the same basis. Rating agencies are going to look at the likelihood and the pain involved with default. And then lastly, with this particular slide, with corporate debt, there are frequently lines of credit. These are oftentimes tied to commercial paper, and again, they are a source of short-term liquidity. It's basically like a gigantic corporate credit card where you can borrow under the kind of allowed provisions, and then you can pay that back at any time. There's usually a fee associated with that to kind of for the bank to hold this line open for you and for you to be able to draw on it. And I think we'll stop there with commercial paper and lines of credit, and move on to the next slide here with respect to corporate notes and bonds. Like treasuries, notes are going to be instruments with maturities of between 1 and 10 years. Corporate bonds are going to have longer term maturities, 10 years plus. In some instances, there have been companies that have issued bonds that go even as high as 100 years. So these are called century bonds, and there's, again, a few of those outstanding. Bonds can be either offered publicly or through private placement. Private placement are bonds that are not underwritten. They are unregistered, so they don't go through a registration process with the SEC, and they are going to be sold basically directly to big investors, to qualified investors, perhaps pension funds or insurance companies, that sort of thing. On the other hand, a public offering is going to have an underwriting process, so an investment bank will do the underwriting. And what they basically do is they're going to look at the company, take a picture of what's going on with the company's operations. They're going to go kind of market that company and the idea of the bond, look at what the appetite is in the marketplace, maybe take some pre-orders, that kind of a thing. And then the investment bank is going to decide on how to offer this, how to sell these securities to the marketplace. A firm commitment is basically the underwriting firm, the investment bank, buying or agreeing to buy all of the securities from the issuing company and then resell those to the marketplace. So there's much less risk for the company, much more risk for the underwriter, as opposed to a best efforts offering, where the investment bank is just going to basically do their best to sell the securities that are being offered, to find a home for all of those bonds that the company wants to sell. There's this idea of a shelf registration. This is kind of an interesting notion and a useful tool for companies. They go through the registration process with the SEC and basically indicate that we want to make this a shelf registration. And so what happens is you don't immediately offer these securities for sale in the market, but you have a period of time, a window, where you can basically go back to the shelf, pull the bond off the shelf, and then offer it to the market when you need to raise the money. So it's basically doing all the dirty work, the legwork beforehand, and then you can pull these off the shelf, so to speak, and go raise that money when you need to. This is similar to the idea of medium-term notes. Again, these are a specific kind of security, and it's a way for firms to borrow money when necessary. The securities are only offered as needed, so perhaps you have a $10 billion kind of ongoing appetite for securities, but you don't want all of that right now. So you wouldn't really want to borrow all of that right now because the interest charges are going to start accruing immediately. But with medium-term notes, you can perhaps sell those securities $1 billion at a time over 6 months, and then in another 6 months you sell another $1 billion, etc. So it's very much like shelf registration, except that these are usually not publicly offered. That is, they're not usually underwritten, so they're not going to go through that same registration process. But these are going to, again, be sold to institutional clients, and they're always issued by institutions as well, corporations. Corporate bonds and notes could either have fixed coupons or floating coupons, and again with the similar dynamics that we've talked about already. And then a frequent aspect of corporate bonds is that they can have these contingencies attached, so they can have a call feature, a put feature, or a conversion feature. Let's real quickly talk about structured financial instruments. These are generally going to be asset-backed securities, such as residential mortgage-backed securities. These are securities, I should say, backed by loans made to homeowners. Or there's another flavor called commercial mortgage-backed securities, CMBS. These are backed by loans made to commercial property owners and investors. They will raise a big amount of money, and then that loan will get collateralized and securitized and sold to the market. Another common structured financial product is CDOs. We'll look at those later on in the semester. These structured financial products can be a combination of all sorts of securities. They can be a package that includes derivatives, bonds, all sorts of things. Basically what's happening through the securitization process is that the company that's creating these structured products is going to cobble together the different kinds of securities, all of which are kind of intended to meet a demand in the marketplace, and they'll cobble those things together and then slice and dice them into individual securities. And so here's a few different flavors of structured products. One is a guarantee certificate. So this is something where you can basically have a capital protected instrument. You can imagine how this might be really attractive to certain companies, certain individuals even, where there's basically a guarantee that your investment will not go below a certain amount. So through structured financial products, they can create these things and basically guarantee that you won't lose money on this investment. There are credit linked notes. These are basically created to increase the yield available to investors. Participation instruments are tied to an underlying asset's returns. So again, if you want to participate in the equity index, you can have this bond type instrument, a structured product called a participation instrument that might be going up if the equity market, if the S&P is going up, or if the NASDAQ is going up. And then lastly, there are leveraged instruments, inverse floaters, which again we're going to talk about in much more detail in a future video. We'll look at this formula in more detail there. But basically the coupon rate for a inverse floater is going to be equal to a maximum coupon amount, and then you're going to take away the product of this leverage ratio and a reference rate. Again, we'll get into that in much more detail in a future video. Let's finish off with this last slide here and talk about fixed income indexes. An index, again, is basically a way to measure the performance of a segment of the market. So just like the S&P 500 is an index, or the Dow is an index, or the NASDAQ 100 is an index, there are indexes for the fixed income world. So a few examples here. The Bloomberg Barclays Global Aggregate Bond Index is made up of a variety of different bonds from 24 different currency markets. It has all types of securities, so it has corporates, it has treasuries, it has actually I'm not sure if it has asset-backed securities or not, but it does have securities from both emerging markets and developed economies. The Bloomberg Barclays U.S. Aggregate Bond Index is a index made up of intermediate term investment grade bonds. So that's kind of a subclass of a subclass. Intermediate term would be something around 5 to 10 years, not short term and also not very long term. So no 30-year bonds would be in that index. The JP Morgan Emerging Market Bond Index would track the performance of bond issues from emerging economies. So we wouldn't have anything like the U.S. in there. We wouldn't have Japan. Europe would not be in there, but we might have bonds that are issued by companies in parts of Africa or Southeast Asia, that sort of thing. So anything that would fit the criteria of an emerging economy. If you want to look at some other possible indexes, you can click on this link here. But I think with that, we will wrap up the videos for Reading 51, and we'll move on to the next one in the next set of videos. Reading 52 will come soon, and we'll talk to you then.
나는 참을 수 없어 운하게버리지 운하게버리지 깨버리지 내가 손대면 뭐든지 지게 되나